We're talking gold and interest rates in today's Kitco Gold Report. And we have interest rate expert Jim Grant. He's the founder and publisher of Grant's Interest Rate Observer. He's also the author of The Forgotten Depression, and he joins us now in studio. Jim, good to see you again.
Good to see you, Daniela.
So Jim, last time we spoke, you had not many nice things to say about gold.
Oh, yes, I did. You have a very nicely selective memory. You know, I was...
You were frustrated. You were frustrated with gold.
Yes, we all are. All of us gold fans are.
But let's look at gold now in its longest run of losses since 1996.
Mr. Market's having a sale.
What are your thoughts on the metal right now?
Well, it is, of course, terrifically vexing, but it is, I think, is a wonderful opportunity. And I say this with all due humility for what one can't know about the future, which is everything. One can't know what the bottom is. But I think the important thing is to recall why those of us who own it bought it. What it is about gold that makes it, or ought to make it, appealing in this day and age when it seems to be absolutely the thing you don't want to have. To me, gold is an investment, not a hedge, but an investment in monetary disorder, monetary and financial disorder. So when you look around the world, you see exchange rates are, I think, properly disorderly. When you look around the world of lending and borrowing, we are in a regime of price control, by another name, so-called 0% rates and quantitative easing by the world's central banks. We are in one of the most radical periods of monetary experimentation in the annals of money. And it could be, this all works out. That is a possibility. I rate that as a very low probability. And for that reason, it seems to me, you want to have exposure to the reciprocal asset of the paper assets that are now most popular. So gold to me is now the conjunction of price, value, and sentiment, and I am very bullish indeed. And
how do you like owning your gold?
Well, I take my losses in all manner of different forms, Danielle. I own Krugerrands, generic, non-numismatic value gold, physical gold. A friend of mine says, when they sell you a Picasso, they have to actually deliver the Picasso. When they sell you gold, they can give you a piece of paper. So I like the physical, and I also am an owner of all too many, for now, gold mining shares. The usual suspects, right, for which I have the highest hopes, and I have the current, a great deal of worry for the present, but a great deal of conviction for the future.
Well, let me ask you that. With these gold prices, though, are we going to be seeing a lot of mine shutdowns?
We could, yes, indeed, and we could see some bankruptcies among the leveraged ones. But I think a portfolio of these things is going to be just fine.
All right, so let's talk about your real area of expertise, interest rates. And I'm not going to
You don't have any interest rates.
I'm not going to ask you when the Fed will raise rates, but what happens after they do? What could it do to the metal?
Well, you know, it's an interesting question. If the Fed does attempt to raise the funds rate, what's going to happen to market interest rates? As we all see, commodity prices are in retreat the world over, which does not speak well for the strength of business activity the world over. And it might just be that the Fed, through institutional pride, is going to raise rates at the wrong time. And if so, it might just be the world says, wait a second, they raise now, they'll never raise again. And furthermore, they may well have to implement more QE or more monetary stimulus to pick up the pace of a most lackluster, at best, global economic picture. So it seems to me that, that it's by no means certain that market rates are going to go up in the face of what we see going on in the commodity markets. And I think where gold thrives or ought to thrive is in the face of monetary turmoil, disorder, and uncertainty. And I think we have all three of these things now and for the present and for the future.
Do you think that the Fed feels rushed to raise rates?
Yes.
Are they in a hurry, and
well,
why?
I think the Fed feels that it has been talking about raising rates what seems now for eons. None of us who do this for a living can bear to talk about it anymore. It makes your face fall asleep. But I think that the Fed now feels it must act just for institutional, institutional pride. But money supply growth is dwindling. The turnover rate of money, likewise. The only thing that is dynamic in the world of money and credit is the issuance of more and more dubiously sourced debt at more and more lenient terms. So, what debt does is two things. It pulls forward consumption, and it pushes back evidence or the recognition of business failure. So you have kind of a backlog of companies that will go bankrupt because they have been strung along by very easy credit, and you have in the present you have consumption that will not be taking place in the future because of the ease of borrowing, a car purchase, for example. So I think all this is setting up for the things that gold ought to love, which is uncertainty, turbulence, and disorder.
All right, and let's end on a note for gold here, Jim. I don't know if you saw any article this week in the Wall Street Journal where one analyst referred to gold as a pet rock.
My friend Jason Zweig, as I reminded him of the pages of Grants, it was Jason who in 2011, within 2 weeks of the top of the bullion price, the then top, wrote a bullish piece on gold mining shares. So at evident extremes, gold may or may not drive you mad, as the proverbs say, but it does make you loquacious. It makes you say things you wish you hadn't said. And for all I know, I'll come back here and say, Daniel, I never said I was bullish, but actually, I am.
Great chatting with you, Jim Grant. Thank you so much for joining us in studio. And thank you for watching this edition of the Gold Report. We'll see you tomorrow.